There is a lot of push-pull when it comes to the administration, their tariff policies. Of course, that big news overnight about the court blocking the use of IEPA. How are your clients thinking about risk-taking at a time when the macro is still so uncertain?
Well, it's delighted to be here. Vivek and I, back 10 years ago, we were together, actually not on this patio, but it's been 10 years of working together. So thanks for having us on the show. And we're delighted to be at our conference, having all these issuers here. And I would say, in terms of risk appetite, I'd say things are pretty measured, but we're starting to see real green shoots of activity. And we see companies really starting to think about, again, how to deploy capital. And from an investor perspective, we've seen some really interesting developments in the markets where larger transactions now are being discussed. And when I say larger, 15 to $18 billion transactions are being discussed. So that's a very good sign for risk appetite.
It's interesting because you have the syndicated loan markets and then you have private credit. I would imagine from a private credit perspective, that type of pent-up activity could be exciting. But what would cause it to materialize?
Yeah, listen, I think that some of that is driven by M&A activity, and so M&A activity will sort of ebb and flow with the macro. I think we all expect sort of M&A volumes to pick up when you think about the sort of age of portfolio companies in the private equity community. And so as they start to monetize those positions, that's going to lead to more M&A, and that'll lead to opportunities for both public markets and private markets and credit.
At what point do people start to get worried about credit deterioration a little more? Things have been pretty complacent, as Jamie Dimon had recently warned. Do you think that the markets are still too complacent? And do you worry that things have to kind of widen out from here before people get more comfortable with taking on some risk?
I think there's a lot of credit dispersion, right? And so certain sectors are very resilient. And so what we see in our credit committee is focusing on which sectors are really exposed potential to some of the macro. And there are a number of sectors that are pretty resilient. And I think what I've seen recently in projections that we've seen from clients is that people have done a pretty good job of dealing with what perceives the perception of higher costs. So I think, at this point, defaults haven't really ticked up, but we're watching it very closely.
What are those places that are immune?
Tech, for example, has had some great resilient software, of course. Some sectors within healthcare services have been very resilient, and then some of the distribution business, and then of course businesses that are potentially not as exposed to tariffs have seen some real resilience. So there's an openness right now to deploy capital, and from an investing perspective, we see that with our financial sponsors as well.
So, if we had this conversation, say, 3 years ago, Christina, how many times have I peppered you about the private credit industry saying, are they in competition with the Goldman's core business? Now, Goldman has made a big push into private credit in a bigger way. When do clients turn to the private credit business versus syndicated loan markets? How do you think about how those businesses work together?
Yeah, look, we have a very, very close partnership. We've been in the private credit business a long time. We started our private credit business about 30 years ago, and it was really started as sort of a partnership between our kind of asset management business, where I currently sit, and with our leveraged finance business. And so because we have such a big presence in both public markets and private markets, it puts us in a position that whether it's people in my business or in Christina's business, when we're talking to borrowers, we can show them the full menu of options, public and private, and we can really solve for them. Think about their use case, think about their objectives, and tailor a solution to them. And so whether that's public or private, we have strong capabilities in both, and we want to really just do what's right for them.
But what are clients choosing ultimately? Because it matters from a supply perspective, doesn't it? If clients want to go private, then it keeps the supply in those syndicated markets tighter, doesn't it?
Yeah, I think the use cases are very specific. So when we present an opportunity set to our clients, we say we can go with a broadly syndicated solution in the loan market, the high yield market, and we have a solution with our partners on asset and wealth management. And one of the reasons we formed the Capital Solutions Group was because we're trying to marry the #1 investment banking franchise with the top alternative asset managers to provide these solutions. And so I'll just give you an example. Let's say you're looking at a company that really wants to have a significant amount of delayed draw powder to make acquisitions. In the syndicated markets, you get basically charged for that. And in the private credit market is actually quite constructive around that one feature. Sometimes clients don't want to get a credit rating. And in the private credit market, you don't need a private credit rating. So there are very specific use cases, and what we see is clients switching back and forth very nimbly. We just did a very successful financial services transaction out of the private credit market into the BSL market with a syndicated second lien that was anchored by the direct lenders that had played the unitranche for that company a year ago. So it's all converging, and that's why we've always been very constructive. These markets are going to coexist. The private credit market now in the U.S. is almost $1 trillion. The U.S. and high-yield loan markets are $1.3 trillion each, respectively. These are large markets.
So what does this mean for private credit in terms of the macro also? Because you have the benefit of floating rate when it comes to private credit. You have a lot of investors saying it's a golden moment. You were one of them a few months ago. You said this is the golden opportunity for credit. But for private credit in particular, how do you balance the risk and reward? Because investors are equally looking to see what the cracks are under the surface.
Yeah, look, I think that, to Christina's point, private credit in general tends to be focused on the more stable industries. So it's software, it's services, it's kind of more stable businesses. But I think private credit starts with good underwriting. You need to get the underwriting right, and you need to take a long-term perspective. And one of the benefits of private credit is that you're making this investment, and you're planning to hold it for the 7 years until maturity, or if it gets refinanced earlier, it gets refinanced earlier. But that's really the framework around private credit.
So, higher for longer environment. We were all kind of taking a look and seeing if interest rate probabilities had changed for the rest of the years in terms of what the Fed might do in terms of cuts. Back in April, the market was pricing in as much as 4 rate cuts. Now it's 2 or less. What do you think? I mean, if the rates are going to stay higher, then how is it that companies don't come under more pressure when it comes to refinancing right now?
So look, I think higher for longer is the theme. I was actually looking back 10 years ago. The 10-year was at 1.75%, or 4.4 this morning. So it's amazing how the world has changed. And the cost of an LBO back then was just over 6%, and now on average it's in the mid-8s. So it's a couple hundred basis points higher, which means obviously the cost of capital is higher, which puts a bit of a governor on the amount of debt. So the quantum of debt's a little bit lower. It's about a turn lower than it used to be. And so I think companies just have to be much more nimble and very thoughtful about how they manage their businesses, whether it's their CapEx plans or working capital. And yes, probably not taking that last quarter half turn of leverage and thinking through putting a little bit more equity in.
It's keeping the belt a little tighter these days. Yep. So from where you're sitting as well in the private credit markets, one big theme that we're seeing is companies that are coming under the pressure from higher rates, whether it's refinancing or whether it's private equity-backed companies that just haven't been able to exit. Rescue financings. Are you interested in diving into some of the things that might be appearing, and how big is that opportunity?
Yeah, it's a good question. So, when people talk about private credit, they're often talking about direct lending. But private credit is much broader than that. And so for us, in addition to our direct lending business, we have a hybrid capital business. We also have a private investment grade business we haven't talked about yet. But in our hybrid capital business, we are more opportunistic. We are able to kind of lend more junior in the capital structure, lend to good companies that, to your point about sponsored DPI, if it's a private equity firm that's been in the asset for a long period of time and their exit's been delayed, maybe because the IPO market hasn't sort of been available to them just yet, we can provide capital to help them, kind of extend the runway and, kind of continue to grow their business so they get to the scale that they need to get to an exit.